Hello, this is Brian Resney, President of Resney Wealth Management. I'm bringing an important update about the economy and the investment markets. We continue to see improvement, not only, of course, in the U.S., but around the world. We're looking at PMI numbers and ISM numbers that actually are getting better. Manufacturing data, of course, is well in the U.S. We've seen just a little bit of a slowdown in that first quarter of this year, and a lot had to do with, obviously, the bad snowstorms and the bad weather that was up north. I firmly believe that will add pent-up demand as we get into the second, third, and fourth quarter of 2014. We look at corporate earnings, and one of the questions I often get on my radio or my TV show is about, stock valuations. Are things at a bubble territory? The market's at an all-time high. You're right. It is at an all-time high. In fact, that statement would have been correct 1, 2, 3, 4 years ago, or if you look at almost any rolling 3- and 5-year period. The reason stock prices are higher, primarily, again, in the U.S., not around the world at new highs, is because of corporate earnings. Earnings drive valuation and drive stock prices higher. If I look generally speaking, how the S&P 500 is valued in the U.S., we're trading around about a 16 PE ratio, which is very much an average over the last 5, 10, 15, 20 years. So things are not overvalued, but the equity markets are at new highs. This is because corporate earnings are the highest they've ever been in history. Fourth quarter is obviously ending from 2013, and all the earnings that we see, we've got close to a 10% earnings growth in the S&P alone. This is, of course, positive. What this means to you, the investor, is simple. Earnings are growing, companies are selling more product. That means there's an opportunity for valuations or stock prices actually to go up. So valuations in general, from the metrics that we look at Resney Wealth Management, are not overstretched by any degree. We're not looking at a 2000 situation where technology stocks were trading at 50, 60 PE ratios. Again, the average in the S&P 500 is around 16. Earnings growth, I would anticipate this year, if we keep on the path of growth in the U.S. economy, somewhere between 8 and 10%. If we look at PE ratios, we kind of take a look at where the numbers could possibly be. Could we see another 8 to 10% rise in the S&P this year and other indexes within the U.S. marketplace this year? Yes, we could. What we are avoiding currently, of course, is still the emerging markets and other sectors around the world because they've been relatively weak. Remember, we run a very strict investment strategy off relative strength. We look at all investment categories. One of the comments or a question that a client had is, Brian, how many different categories do you look at, or are we always just invested in the stock market? My answer is simple. We are not one-sided. We are not lopsided at Resney Wealth Management. Unlike most firms that just buy equities or just buy equity mutual funds or just buy bonds or bonds and stocks, we look at all asset categories around the world, not just the stock market and not just the bond market. Now, relatively strong has been our small and mid cap in the U.S. for a long time, and we continue to own that and add to that. There will be a point in time, even in our growth portfolios, that we could be sitting on substantial amounts of cash, inverse ETFs, treasuries, gold, or other assets that are relatively strong if, in fact, the economy slows and we go into a recessionary period. So again, at Resney Wealth Management, it's different. We're not Wall Street. We're not the so-called advisor. We don't do the pie-shaped asset allocation that has failed, in my personal opinion, and doesn't provide risk management. We look at all asset categories. We rank those categories against one another. We own the relatively stronger categories in our client portfolios, and we basically make appropriate changes to those asset categories and those sectors when our strategy dictates to do so. That sometimes means getting ultra conservative, even in our growth portfolio, all the way down to our income-oriented portfolios. So at Resney Wealth Management, risk management is an important part of what we do. So again, we look at everything. We'll own what's working or relatively strong currently, and we'll make changes to that portfolio and get ultra conservative if we need to. By the way, all of our recessionary numbers and our growth numbers are actually getting a little better and are in an uptrend. We're not seeing any negativity for any kind of recessionary indicators, at least between 9 and 12 months out. This is a positive. Of course, if you're a client of Resney Wealth Management, give us a call. If you're not a client of Resney Wealth Management, it's about time you called our office, made a consultation, and find out what the difference really means to you in your retirement. By the way, I've got a live TV show tonight. And if you're not in the viewing area for my TV show, it will be uploaded by noon tomorrow. Also, we have a cocktail reception market update for our clients and their guests. We have them in March and April. Of course, clients, you've received invitations. This is a client-only event, and your guests. And by the way, clients, your guests would love to attend and learn what we're going to talk about, and also come for a nice, enjoyable evening. Make sure you call our office to schedule any update appointments, and also to make sure that you book that you want to attend either our Boca or our Bonita Springs cocktail reception update. Have yourself a safe and profitable week.